Let me thank the three people on this panel and authors of the paper, of their chapters in the Festschrift. We have the three chapters in this section on finance. The first being presented by Dagmar Ertova. Dagmar has written this chapter on growth-linked securities with Stephanie Griffith-Jones. The second is the chapter on capital mobility and regulation, authored by Olivier Jean. And the third on finance by Avinash Persad. With no further ado, let me go to Dagmar and kind of welcome you to the Institute, Dagmar. This is the first time we've met, and we appreciate you coming down from New York through post-hurricane conditions to be here.
Yes, thank you. I think I'm quite lucky to make it here, coming from New York. But I'm very happy to be here, and unfortunately Stephanie couldn't be here, but I'm here, and I certainly won't get the prize for knowing John the longest, because we only met in 2007 when he was visiting at London School of Economics, and where I was helping him do some research on GDP revisions towards his work on growth-linked securities. So growth-linked securities, they're not exactly a new idea, but relatively new if you think about it in comparison to some of the other things that were mentioned here today. But we all know John's 2005 book on curbing the boom-bust cycles. And there he focuses on the need to stabilize the boom and bust of capital flows to emerging economies. And he also proposes detailed policy actions to curb these movements, and he also focuses on GDP-linked bonds as one of the measures. Unfortunately, growth-linked or GDP-linked securities, they've been only implemented to a limited extent, and only by countries that have been having difficulties in servicing their debt. But the general idea is that these instruments should be issued in good times as a precautionary way, because in this way they can be beneficial for all the actors involved, and investors would be keen to invest in them. They're basically bonds that promise interest payments that vary according to the issuer country's growth performance. And so in good times, the country would pay more, and in bad times, it would pay less. And so in this way, there's this counter-cyclical element in which they help stabilize government spending and limit pro-cyclicality of fiscal pressures. And requiring lower debt servicing in bad times mean that there's a lower likelihood of defaults and debt crises. And this, of course, extends to the investors also, because they're likely to lose as a result of defaults. Growth-linked bonds, they would also allow investors to take a position on a country's future growth. And in this way, they can provide a diversification opportunity if investors were to hold bonds linked to growth of different countries. They're also, on a larger scale, there are benefits to the international financial system that go beyond the investors and the borrowers. And so they can be viewed as a global public good. Now, there have been different variants proposed. Robert Schiller, for example, proposed GDP-linked bonds that would offer an interest of permanent fraction of the issuer country's GDP. Eduardo Bornstein, Paulo Mauro at the IMF, they proposed a bond that would be like a standard bond, but the interest rate would vary depending on the growth rate of the issuer country. Another interest rate, another variant similar to the one before, but where the excess payment would be either added or subtracted from the debt stock. And John has really argued that there's differences in this design of these bonds that would imply differences in the payment, in the amount of payment, and in the timing of the payment as well. As with any new instruments, there are some concerns. The ones mainly highlighted were those of moral hazard, that a government would be tempted to either suppress growth or underreport growth in order to avoid payments. Now again, John has argued here that this is sort of overdone, that this is not very likely. It's not likely that a country would suppress growth. It would just not be worth it. And underreporting growth, again, for the same reason, you want to say that your country is growing more than it is, maybe. And systematically underreporting growth would also be difficult from a technical perspective. A related concern, however, is what would happen when there's GDP revisions. And now this is something that I helped John look at, and we looked at a huge data set of countries, 20 years, 60 countries, and look at the revisions in GDP. And what we found was majority of them were quite small, routine revisions, but those that were larger, they average at 6.7%. And so it is a consideration that really should be taken into account when designing growth-linked bonds, how to deal with revisions when they happen. In the paper with Stephanie, what we really try to do is to look at the existing experience with these instruments. So Argentina issued GDP-linked warrants as part of its 2005 restructuring, and there were some additional ones during the 2010 restructuring. And the payment on these bonds was set up to equal 5% of the excess GDP level. So the amount by which GDP exceeds the baseline that was set up in the design. But this payment would happen only if real GDP is above a baseline level, and also real growth is above a certain specific level, and then if a total payment cap is not reached. And this has been set at 48% of the value of the warrants. And in those graphs here, I believe they're on page 135 in the book. So on the left, you see the level of real GDP, and the long line, that's the baseline, and you see the actual growth and actual GDP level, and the estimates going up to 2016, and on the right is the same but with GDP growth. And you see that initially the bonds were not, the investors didn't attach much value to these bonds. But then as the level of GDP in Argentina grew rapidly in the first years following the exchange, and because the payment is based on the level of GDP rather than the growth, then there have been very high initial payments. And this also implies that it's likely that GDP level will stay above the baseline in the future. And so it increases the chances of future payments and increases the value of the warrants. This table is just looking at how much the Argentine government actually paid out on these warrants. So you'll see in 2006, it was just 395 million, but this has gone up to 1.4 billion in 2009, 2.4 in 2011, and it's projected to rise to 3.8 billion. So cumulatively, it's been about $6 billion that the government paid out on the warrants, and this has already been a quarter of the total payment cap. So, and you can see, looking at some of the other indicators, as percentage of total interest servicing, interest on the warrants has gone up from 10 to 30%. So it seems like they're becoming quite burdensome for the government. Another concern that we looked at was, you can see that in 2010, the government didn't make any payment. Because of the lag of data publications, there's a lag of 1 year. So there was no payment in 2010 because the growth in 2009 was too low. But you can see that the year 2009 was really the bad year with low growth, fiscal deficit has gone up. And so that's really the year when Argentina could have done without paying the interest. So one can argue that maybe in this sense, the counter-cyclical element of the warrants may have been somewhat limited because of the lag in publication of data. Now, another more recent experience with GDP-linked securities can be taken from Greece, which issued GDP-linked bonds as part of its huge debt restructuring earlier this year. And the setup of these bonds is a little different. The payment is 1.5 times the excess growth rate. So it's based on the growth rate rather than the level of GDP. And again, there's several conditions on GDP and growth that have to be met. And there's also an annual payment cap of 1% of the value of the bonds. So what are the differences between these two cases? First of all, the Argentine bonds, the payment is based on GDP level, whereas in the Greek case, it's based on growth. So whenever there is a missed payment, in the case of Argentina, as there was a case in 2010, this missed payment will effectively be made up for in the next year or whenever the next payment happens, because it's based on the level of GDP. Whereas in the case of Greece, any missed payment is effectively lost. Another difference is the total cap versus the annual payment cap. So in Argentina, those warrants actually turned out to be very attractive for investors. But on the other hand, it seems like they're becoming quite burdensome for the government. But you can see the Greek warrants may have been, you can argue that they were designed better from the country perspective with the annual cap. But then they may not be as attractive and as valuable as the Argentine warrants. So in conclusion, they're a new instrument. They're not very common. And so they should be designed in a way that's very simple and specific and transparent. And ideally, it should be standardized. As I said before, they should be issued in normal times. And John has argued that because they have this characteristic of a public good, they're also a new instrument, and also the market for them would be very illiquid. And so there's a case for large action to happen to push this instrument forward and to achieve the critical mass and ensure market liquidity and the risk diversification benefits. And so multilateral institutions could really be involved in this. You could have multilateral or regional development banks issuing loans that would be linked to different countries' growth rates. And such a portfolio of loans would be very beneficial for investors because it would offer the ultimate diversification of risk. And let me finish with that.
All right. Dagmar, thank you very much. We will now turn to another area that John has worked on a lot in his career, capital mobility and regulation, as we call it here. John's latest book for the Institute, which he co-authored with Olivier, was entitled, Who Needs to Open a Capital Account? I say it's his latest book for the Institute. It may not be his last, who knows, may do more. But this was one we published this spring, and Olivier is going to present that aspect of John's work.
So thank you for inviting me. It is a pleasure and an honor to speak in this conference. And as Fred just said, I'm going to talk about a topic which may not be the area in which John's work is the most well known, the Washington Consensus or target zones, which is his work on capital flow management. So here I'm putting John's work in perspective by showing a measure of capital flows to emerging market countries and the dates of several pieces, analytical pieces written by John. And I'm going to talk mostly about the first one, 1995, the management of capital inflows, which is really the English translation of a paper that John had published in Spanish in the early 90s. And what John said in this contribution, the point of the contribution was to warn emerging market economies, but mainly Asian emerging market economies at the time, about the risk of excessive capital inflows. And this is an analytical piece in which John makes a number of points that have become more familiar now and almost conventional wisdom, but were pretty striking at the time. First, it argued that capital inflows could lead to currency appreciation and a Dutch disease. Second, he called the attention of the reader to the fact that a fraction and a substantial fraction of these capital flows took the form of short-term debt or foreign currency debt, and that this was dangerous from a point of view that we would call macro-prudential now. Another problem which John wrote about, and I'm going to cite him, is the risk of bubbles in asset prices. So John wrote, one undesirable consequence of such a bubble is typically a decline in the local savings rate as individuals discover that their asset accumulation objectives are being achieved without the need for anything so tedious as abstaining from consumption. Another undesirable consequence can be a financial crisis and the danger of a recession when the bubble bursts. So John had an emerging market economy in mind, but it's difficult to find a more appropriate description of what happened in the US before and after the most recent crisis. And in fact, if you look at the recent academic literature on the risks associated with current account deficits, it is really exactly about this idea. If you look at, for example, Maurice Obstfeld's lecture at the last Congress of the American Economic Association, his keynote lecture, this is what he says about excessive deficits, or the reasons why current account deficits can be excessive. And then in the same piece, John presents a list of 12 possible policy actions for curbing the effects of surges in capital inflows, and I'm not going to go through this list, but he carefully compares the merits and drawbacks of these different policy measures. Now remember, this was the early 90s, right? So this is the time when emerging market finance was a new concept. This is the time when we or the world thought that we had finally figured out how international finance could help development, because capital flows were going to the private sector, not to the sovereigns, as was the case in the 70s. It was before the Asian crisis. It was even before the Mexican crisis. Now, the Mexican crisis came and started to trigger a debate about the international financial system, and then the Asian crisis in '98, which John observed from a very good place as chief economist at the World Bank, right, for Asia. And after that, a debate about reforming the international financial architecture. Now, at that point, you could think that the world would say, well, we were wrong, John, you were right, and we have to look at, we have to implement those measures. But in some sense, what happened was, and paradoxically, was the opposite. So actually, both the debate and policy measures at the end of the 90s moved away from what John was proposing. It is in '98 that Chile dismantled completely the prudential capital controls that John was praising in his earlier work. And then there was, the new recommendation was this polar view that was about exchange rate regimes that was discussed earlier, which is moving away from intermediate regimes, target zones. Be it as it may, after the crisis, capital flew back to emerging market economies. In 2005, John published a Peterson Institute monograph, Curbing the Boom-Bust Cycle, in which he reiterates and refines a number of proposals that he had made in his earlier work. But again, this is not what emerging market economies were doing at the time. They were not, they were essentially accumulating very large amounts of reserves, something that we're not doing in the 90s. But this is not exactly what John was proposing in his work, which was more macro-prudential in nature. And then fast forward, the last crisis, and this is where I come into this story with this book that Fred talked about, Who Needs to Open the Capital Account? And we started thinking about this book at the time of the global financial crisis, 2008, 2009. And we had a problem. First, we couldn't just say that we were right all along, because it really was just John who was right. I mean, Arvin and me had no track record of being right on this topic. And then we found that the conventional wisdom was moving too fast to our taste towards John's position. So we started by writing and refining John's insight about prudential controls. But then 2 months later, the IMF was publishing a paper in which it was endorsing prudential capital controls. The G20 then endorses these controls. So we were trying to move a little bit more to the left, but the IMF itself was moving. And in the end, we were really mainstream and trying to make too much of very small nuances between what we were saying and the new conventional wisdom. So we tried to push the frontier by asking a question which I think is a new question and is going to be increasingly important looking forward, which is the question of whether we need an international regime, international rules of the game for what we call capital account policies, which includes capital account restrictions, but also reserve accumulation, foreign asset accumulation by the public sector. Now, we are in a strange situation where we have very strong international rules for international trade with the WTO, but no international discipline for capital account policies thus defined. A country can choose to have a very closed capital account like China or a very open one like Chile. Now, what is at stake here is whether those capital account policies are a periphery issue or systemic issue. I think many people look at this question as related to the as a core periphery question, right? So there are capital flows. with ebbs and tides. They come from the core of the financial system, they go to the periphery. It's destabilizing for the periphery. So the periphery may have to adopt some measures, some prudential capital controls. So it's one way of looking at it. But when China has a very close capital account, and China has the second largest economy, or maybe even the largest economy, if you believe what Arvind Subramanian has been writing on that, then is it really a core periphery issue? If you can manipulate the real exchange rate using capital account policies, and thus achieve exactly the same results as with tariffs, trade policies, and one can formally show that in a model, then does it make sense to have a lot of discipline for trade policies and no discipline at all for capital account policies? And is free trade sustainable if there is no discipline at all for capital account policies? So one point that we make in this book is argue in favor of an international regime for capital account policies, an international regime whose aim would not be to achieve free capital mobility, because there are reasons, prudential reasons to limit the movements of capital and certain forms of capital in some circumstances, but also would define by exclusion the capital controls that may be harmful and distortive for trade. Now, another thing I would like to talk about, since my main affiliation is academic, and so unlike most of us, but like Marcus, we cannot ignore those DSG models. We have graduate students, and either they do empirical work or they do theoretical work, applied theory. And if they do applied theory, they have to work with DSG models. And there are reasons why these models are useful and why I like them. But one problem with this literature is that it tends to ignore what was written before the DSG wave. Sometimes it rediscovers the wheel, and sometimes, more troublingly, it just ignores old insights because they do not fit in the new framework. So one thing I do in the chapter in the book, and I'm going to summarize it very quickly, is to make a list of questions for researchers that are suggested by John's work and are still open questions. So it's both a tribute to John's work, and at the same time it's trying to be socially useful by giving research ideas to students. So here is a list. What is the welfare case for curbing the boom-bust cycle in capital flows? So actually there is quite a bit of work now exactly on this question. It did not exist when John started to write about that in the 90s, but we have now a literature, a welfare-based literature, in which it is possible to derive the optimal capital controls. Another idea of John was that capital flows could be harmful because of the Dutch disease and induce excessive real appreciation. Many people believe that, and it's a very natural idea, but surprisingly there is very little theoretical work on that. Third question, how does reserve accumulation work? So before there was a discussion about sterilized reserve accumulation and how it could have an impact. Now here, modern theory has a very simple answer. Sterilized reserve accumulation has no impact, except if you have at the same time capital controls. But there are reasons, and Joe Gagnon's work is one of these reasons, to believe that in fact, even when the capital account is open, sterilized reserve accumulation may have an impact, but it's not something that we understand well. We don't have any theory for that. Next question is the question I asked before. What is the case for international coordination of capital account policies? There is a huge literature on trade. What's the trade for international rules to promote free trade? But what about capital account policies? Essentially empty. There is no theoretical literature on that, well, except one or two papers. International banking integration. That is certainly suggested by the most recent crisis, which was a banking crisis and involved mainly banking flows. And so what kind of capital, prudential capital controls is justified by international, excessive volatility in international banking flows. So to conclude, there are several theses to be written based and inspired by the ideas that John wrote about since the 90s. Thank you.
Thank you, Olivier. Thank you, Olivier. Now we turn to Avinash Persaud for the last of these papers on international finance.
Thank you, Fred. Good afternoon, ladies and gentlemen. I stand here with great feeling and great pleasure to have to be here with you and to be contributing to this fine Festschrift. I'm not going to win the prize for the person who's known John for longest. I'm that generation of economists for whom the gospel is according to Dornbusch Fischer, and so quite some way on. I'll probably be lapped by a few of my colleagues. But I think there are few people who have actually been as inspired as I have been by John's work. I spent the first 20 years of my career as an exchange rate economist, working in the private sector for large institutions running currency research, and led into that field of economics very much by reading John Williamson's work on exchange rate economics. So it has been a very important aspect of my own career. And, you know, John, ever since John Maynard Keynes was so disparaging of practical men as being those led by some defunct economist, economists are afraid to say that they are practical, but John is not only a huge intellect in economics and has influenced theory, but is also, I would say, a policymaker's economist and a practitioner's economist. There have been many a bewildered hedge fund manager who's left a meeting with me thinking, why is this private sector guy talking about target zones and intervention and capital controls? But I think these are things that certainly John's work resonated very much with me in terms of the reality of the exchange rate markets and international finance. You know, the hallmark of a good scientist is not necessarily the amount of math in their theory, but the keen observation. And John is a keen observer of what was happening. And indeed, as things that have happened have evolved, so has the focus of his work. So exchange rates, when I first came upon them as a practitioner, and I said this, John's work very much resonated with me. Here was a market where we had these theories about exchange rate determination, and yet the exchange rate market seemed to be very different. Indeed, after a decade or so of studying exchange rates, I sort of developed 7 rules of foreign exchange. And the first rule, I'm not going to go through all 7, but the first rule is that exchange rates move to that point which provokes a policy response. If you look at the chart of exchange rates, you find the tops and the bottoms are not the market screeching to a halt because the fundamentals are so stretched and the valuations so stretched, but there's been some form of intervention, either in the foreign exchange markets or policy. Look at a chart of the tops and bottoms of exchange rates, the major exchange rates, and you will see that. And why is that? It's partly because the forces of fundamentals are weak. So exchange rates will continue trending. In fact, those trends develop forces themselves that are self-fulfilling, and they need to be guided in some way back to more appropriate levels. And so the notion that markets need to be guided exchange rates need to be guided, constrained in some way, not too rigidly, because we don't know exactly where they ought to be, but bounded in some way. Certainly made a lot of sense to me. But I would say much of John's work on exchange rate economics needs to be seen in the wider context of a deep concern about what was discussed earlier about the ebb and flow of capital, the feast and famine of international capital markets. And for a long time before this great financial crisis, the feast and famine of capital flows was something you would read about in books and you'd observe happening in foreign countries. But of course, this was extremely important for emerging economies. Indeed, I define an emerging market as a country with limited absorptive capacity. And so when you have enormous feasts and famine of international capital flows, emerging markets quickly develop booms, and those booms bust, and the consequences of those are enormous. If you had no economic data, and all you had was infant mortality data, you could identify the timing of the Asian financial crisis. These booms and busts have very significant implications, not just financial, not just economic, but humanitarian as well. I think that, so there was a raft of policies developed trying to deal, which essentially this characteristic of our non-system, of the large ebb and flow of capital. And exchange rate target zones, exchange rate management was part of that raft. And there are others, capital controls, not full liberalization of the capital account in some way, sand in the wheels of finance. I think this financial crisis, however, has led to the development of some very different tools which may be called macro-prudential, which I think need to be seen in this wider context, are actually modern-day versions of some of these other tools and are being seen as ways of dealing with the ebb and flow of capital. And so my second part of my remarks, I want to focus on the new development of macro-prudential rules, how they've developed out of financial regulation, and what are their wider impact, in my belief, in the area of international capital flows. Most politicians have the bad apple theory of financial crises. They believe, because they're required to respond. A financial crash happens, there's enormous consequences, we demand our politicians to respond. And a favorite theory of theirs is the bad apple theory, which is that financial crashes are caused by bad bankers using bad products out of bad jurisdictions. And this allows a politician to jail the bankers, ban the products, and close down the jurisdictions. But I think it's a convenient idea. But the problem with the bad apple theory is if that was what happened, financial crashes would in fact be quite random. They would randomly occur when there was this bad apple that comes about. But in fact, financial crashes are not random. Financial crashes always follow financial booms. And financial booms are not caused by people doing things they think are risky. Another convenient idea. Financial booms are caused by people doing things that are safe. In fact, they think it's so safe, you can double up, treble up, leverage more. And that's what inflates the boom and leads to the bust. And our traditional forms of financial regulation weren't really dealing with this issue of common behavior. Throughout today, a number of the speakers have been talking about thinking of economics beyond that narrow aspect, to thinking about behavior. Financial crashes are a result of behavior. A behavior that leads to these booms. And traditional financial regulation was focusing on the micro-prudential safety of individual banks. And it missed the fallacy of composition, that every individual bank can be safe, but the system unsafe, because doing what's in your private interest may not be right in the social interest. And indeed, one of the fascinating fallacies of previous financial regulation is because we were so unambitious about policy and regulation, markets took over financial regulation. And at the heart of Basel II, old financial regulation, was in fact we should leave it up to the markets. And we should define risk as the way the markets define risk, whether it's through credit default swaps or credit rating agencies. And of course, this made the crash a lot worse. Because at the top of the boom, the reason why we have a boom is because perceived risks are low. And so, in fact, banks were putting aside less capital. The regulators were saying in 2006, the banking system is safer than ever before. Just when you wanted the banking system to be putting aside more capital, because markets are booming and believing risks are low, they're putting aside less capital. So the new financial regulation is about curbing the role of markets and, in fact, introducing non-market instruments. What is a leverage ratio? But a way of putting a cap and a limit to market-perceived risks. What is the counter-cyclical provisioning or counter-cyclical capital adequacy ratios? But basically saying you can't leave it up to the perceived risk in the marketplace to determine your capital. You've got to add some more, a non-market intervention. And I think that's been a very interesting development. And I would say my final point would be that we need to do more than that. If booms are caused by our perceptions that risks are low, then we can't have financial regulation that is based on perceptions and statistics. Indeed, I would say, hesitant to get into the debate on whether John is a Latin American structuralist or not, I would say that we need to move financial regulation away from statistics to structure. And the way we make a financial system safe is by putting risk in the financial system to where there's a capacity to hold that risk. And so we should encourage banks to match their credit risks and match their liquidity risks and match their market risks and ask them to put aside capital where they can't match them. And what that does is it incentivizes risks to flow to those institutions that can match them and creates a structural diversity in the financial system which makes it safer. So what I'd like to say is that we've been thinking of there's some old tools that we've debated about, exchange rate target zones, exchange rate management, capital controls, as defense mechanisms for the ebb and flow of capital, and for the way that capital can ebb and flow in such a way that has dramatic impacts on economies, on societies, on some of those human things I talked about earlier. And I think what we're seeing with this crisis, an evolution of a new set of measures, which actually end up having the effect that John was looking for in terms of helping to tame the volatility of capital flows and reduce the kind of boom-bust cycle. And I think these new tools are in the camp of macroprudential. They're about counter-cyclical. They're also about structurally trying to put risks in different places. And one of the key things about them is that they don't make a division between what's foreign and what's local. If you've got a boom in your country, it doesn't matter whether the lending is coming from abroad. It matters a little bit whether it's short-term external debt. But it doesn't matter so much where it's coming from. The point is you have too much activity, too much borrowing, and too much lending. And these macroprudential rules, I think, will tame some of that and make the system more resilient and less prone to the boom-bust cycle. Thank you very much.
We've talked today about two bodies of John's work. One was on exchange rates, effort to find a middle course, limited flexibility models, target zones, et cetera, monitoring ranges, reference bands, and the like. And you talked about this latest body of work with you and Arvin on coming up with an international regime for capital flows. What's the relationship between the two? Are they alternative ways to skin the same cat of avoiding currency misalignments and big external disequilibria? do they reinforce each other, so one should think of them as complements to pursue both? Talk a little bit about, and I'll ask John to do that too if he wants in his final remarks, but link up those two strands of John's thought and your own, I know, to put together in more maybe a general equilibrium sense how all this might play through into a grand new global regime.
Speaking in front of John, it feels a little bit like taking an exam. But yes, I mean, there is this theme. I don't remember the term that you used in the introduction to describe the philosophical approach of John, but I think it's the qualified benefits of markets, something like that. I mean, clearly in John's work there is this idea that if you leave everything to markets, things tend to be too volatile.
Right, markets get it wrong.
Yes,
in
so
terms
it's
of
true
capital
for
flows,
capital
in terms of
flows,
exchange rates.
and it's true for exchange rates. And then capital flows and exchange rates move together, and so it's completely consistent to. I mean, the idea of target zone and the idea of managing capital flows are completely consistent from that point of view. But
John, go up to the mic. Yeah, go up to the podium. Don't scoop yourself.
I would say that, no, don't why, it's a quite different subject. But I would say that you've got it right, that there are two alternative means which go to the same end. One is hoping to have a world in which the exchange rates are roughly appropriate, and to achieve that, one has to restrict capital flows. So, yeah, I'd say that consistent, and is essentially the same, goes to the same group.
Let me ask Stan, how real is any of this? You've cited this morning, and you and I have talked privately, about how you as a central banker get sucked into the currency wars. You've got to defend your country when other people are cheating in the markets, intervening, manipulating, whatever one wants to call it. So you have to do it. So is any of the stuff we're talking about here a more constructive way to go about dealing with that?
Well, let me just say something first, which I didn't think when we got into intervening that we were suffering from the currency wars. I think I was aware that there was a global adjustment mechanism which was supposed to happen, and that we were supposed to contribute. I couldn't quite figure out why we were supposed to have a recession, because the United States had screwed up its supervision of the financial system. And so I had much less, we had much less, in those days I was the sole decision maker, so I had much less concern about intervening and frustrating this global adjustment mechanism than I would have if some hurricane had struck the United States and caused immense damage and so forth, and it was supposed to devalue as part of the adjustment mechanism. So that was then. Now, I think these are two. I think there are two different approaches, and furthermore, I think the one that Olivier talked about is actually happening. I think more and more constraints are being put on short-term capital flows as a way of blocking these very short-term movements, whose, the welfare economics of all this is much less well known than the theory of comparative advantage. You can put it in comparative advantage terms, but it's at such a general level that you don't quite know why short-term capital flows in particular are really an essential part of what makes the economy efficient. And by blocking short-term flows or impeding them, or at least treating them, we had until a year ago tax benefits to foreign investors, well, including for short-term inflows. well, so we stopped that. Well, that wasn't quite discrimination against the foreigners, but there are lots of things. But I would relate this mostly to short-term flows, and if you're doing that, then I think you're reducing the need to intervene. You're reducing the need for the exchange rate to adjust. And so they are two ways of getting at the same thing, or they're substitutes actually for each other. And I think having the, I think the intervention, we had this discussion 10 minutes ago, or half an hour ago. Intervention is a much more uncertain and messy way of dealing with these issues than trying to get the structural framework, tax framework and all that, and the supervisory framework correct, rather than having to go in every morning and figure out what the heck you're supposed to do that day. It's a little better to get a structure in place that you hope will mitigate this stuff.
But Fred, I want to say there are three ways to skin this cat. Because what we're seeing now in revised Basel II is the ability for a country facing a boom, facing exchange rate appreciating capital inflows, to say that I'm going to raise my capital adequacy requirement in the banks. Because where's that capital going? Foreign money goes to the banking system and the real estate often. So you raise that capital adequacy, making the banks less willing to on-lend, not accepting this capital, turning it away. And therefore, you're going to reduce the inflow and reduce the exchange rate appreciation. And now this is not a hoped-for capital control. This is in revised Basel III already there.
I was going to make a comment and a question. Comment is a bit analytical, and that is that we need to sometimes distinguish between gross and net, right? Because you can't have net capital flows unless you have something, a counterpart in the current account. So in some sense, you're talking about the composition of and if you don't have any change in the current account, then you're actually talking about in the short, which you don't have in the short run. You're talking about the composition of the capital account on both the inflow and the outflow basis, which part of which involves intervention, and part of which may involve other kinds of features. But I think in some sense, our thinking about these issues is not as well developed because the failure, though this is changing, to focus on the gross, the failure to focus on the gross and the different channels. Indeed, you don't have to have any flows for the exchange rate to move, right? You don't have to have any recorded net flows to have the exchange rate, or even any gross flows to have exchange rate moves. You don't have to have Q's to get P's to move. But it seems to me the one point that where you're all addressing, and actually all three papers do this in some degree, that's where the question is, it really does involve issues of global governance. Comes back in a bit to the international monetary system, financial system kinds of questions. And one does have the impression, I may be wrong about this, but I have the impression that to some extent in the current revised debate, and you may do this in your paper or your book with John, and I don't know it, Olivier, the resistance to ground rules for, if you want to put it that way, rules of the game for capital, with respect to use of management of capital movements, is now coming not from the advanced countries, but from the developing countries. They say, we don't want to have our hands tied. I may be oversimplifying. We don't want our hands tied. So you have the same kind of stalemate that you have in a lot of other areas of global governance, right? Where the view is we want to preserve our options to be eclectic, if you want to put it that way, without having any sense of less of a sense than I think most of us would think is sensible, to embrace something which is a public good. I guess is the language that John uses. A public good because at different points in time it may benefit one set of countries or the other. So I wondered whether, and in some sense this relates to the growth-linked bonds as well. It is the same kind of public good kind of argument, even though there may be in the short run winners and losers from having the regime operate.
Okay. Any responses to that, or anybody else? Bill Klein and then Pat Malloy, and then we're going to go to the final part of the program. Bill. Yeah, go to the standing mic, I think.
I just want to urge a little caution in John's conclusion that you have to have capital controls to get equilibrium exchange rates. I think he actually said that. Does he really mean to imply that in the Plaza Accord that what we should have done was to have Germany and Japan impose capital controls, or that the United States should have imposed capital controls on capital coming in? And again, if you think, as Joe, I guess, has written, that you can have, you don't have to have the perfect trinity. I do think this whole discussion about even the boom and bust needs to constantly keep a cost and benefit, even the regulation. Should we have banks have 100% leverage ratio or leverage requirement on capital? There's got to be some optimal level somewhere. And the name of this game in general is to make sure that the potential gains that you get from faster growth, which in some sense is correlated with more open both capital and trade markets, is not sacrificed by an excessively rigid, controlled, non-market framework. So I guess probably John doesn't mean that the United States needs capital controls, but that also implies, after all, the most extreme capital controls are the country that's the most undervalued, which has been China. So I just want to urge a word of caution that appropriate exchange rates require capital controls.
Patrick?
I'm a lawyer, not an economist, but I was general counsel of the Senate Banking Committee in 1988 when we wrote the provision of law requiring Treasury to identify countries that manipulate their currency. And the reason we did that is because we thought it was happening, and we thought it contributed to trade deficits and imbalances. The world now has huge imbalances. Part of the imbalance was created by the fact that the United States has run about $10 trillion worth of current account deficits in the last 20 years, probably $8 trillion in the last 10 years. Should the United States adopt a goal of having a balanced current account so that we get some discipline into the system that requires us to consider that when we're making public policy?
Okay, we put that on the agenda. Let me ask if anybody on the panel has a rejoinder to any of this. Both Olivier and Avinash?
Give you more time to think, huh? Okay, so the first point I'd say is, if we were in Mars and someone said the world had a very efficient international financial system, would we expect zero current account balances? No. In fact, you might expect really big ones. Really big ones might reflect a successful financial system. Now, we know we have a dysfunctional system today, but I would caution against believing that zero is a goal. We want sustainable, and what is sustainable will change over time.
Olivier?
Yes, about rules and the reason that countries like Brazil, for example, do not like the idea of the IMF having a role in designing international rules for capital account policies, which is true. I mean, Brazil was one of the main opponents to this idea, even though it is the new poster child after Chile for prudential capital controls. Well, maybe it's because the IMF has not gone far enough in making clear that having some kind of jurisdiction over capital account policies, for example, does not mean promoting open capital accounts, which was the perception when this debate took place, for example, in the 90s. So maybe there is more work to be done to make clear that the objective of such rules would be different. Should the US have the goal, an explicit target for the current account, and should this target be zero? Well, the problem is that if the US is not able to change exchange rates, then the only way it will achieve the target is by reducing domestic demand and having a very high level of unemployment. So I don't think it's a credible target, unless there is a mechanism to change the exchange rates in a way that will make it possible to achieve the target under full employment.
And then the way to do that, of course, or at least part way to that, Olivier, would be to get the countries who intervene to keep their currencies undervalued to stop doing so. But we'll leave that for another day. Thanks very, Sam, including Israel, of course. No, but I give you your defensive intervener.
Well, I'm speaking as a former IMF official. In 1997, we argued that what you needed was jurisdiction for the IMF, and we expected that there would be developed the equivalent of Article 14 status and Article 8 on the current account. That is, that you do this for the capital account. That you'd announce you have all these restrictions and you'd be allowed to have them. And at some point people would say, we accept the principle of, or whatever it is, that you do when you go to Article 8. So I think the issue was, my sense was, they'd had enough of the IMF interfering with the things they wanted to do, and they didn't feel like giving the IMF another excuse to come in and criticize them. And I didn't think it was based on, well, they liked using capital controls, but I didn't think it was based on a deep argument about whether it was good to have capital controls or not. Certainly it was very hard to persuade that this was what would happen, the Article 8 to Article 14 combination, so they didn't trust the fund at the time.
Okay, we'll take that as the last word for the moment. Thanks very much to Dagmar, Olivier, and Avinash for this particular panel. We appreciate it enormously. Thank you very much. And now, for the last word of the day, we will turn quite appropriately to the honoree of the day, John Williamson. The Festschrift was for him. We're all delighted to have presented pieces of it in the course of this conversation. We thank all of you for coming, and we look forward to hearing from our honored guests.